Are you considering getting into options trading? If so, you came to the right place. In this video, we're going to look at the differences between stocks and options, as well as the advantages and disadvantages of both. After watching this video, you should know which of these trading paradigms is right for you and how to get started. With that being said, let's start breaking down the pros and cons of trading options versus stocks. The first advantage that stocks offer compared to options is that stocks give you equity, whereas options don't. Buying stock gives you ownership rights of that company. These rights could include the right to receive dividends, voting rights, and more. Options, on the other hand, offer none of these benefits. Especially for passive long-term investing, this can be a deal breaker. Another factor that speaks for stocks over options is liquidity. Compared to stocks, options are much less liquid. Since there are so many different options, the daily volume of an option will almost always be lower than the volume of its underlying asset. A daily volume of a few thousand contracts of an option is considered very good, whereas the same volume would be considered terrible liquidity for stocks. With that being said, there are many securities with very liquid options. Typically, if a stock is very liquid, its options will also offer good liquidity. So if you focus on the right securities and the right option contracts, this shouldn't make too big of a difference. Nevertheless, it's important to always check the liquidity of an option before trading it. Even though stocks tend to be more liquid than options, they also tend to be much more expensive than options. You need much less buying power to effectively trade options than to trade stocks. A single option contract controls 100 shares of the underlying stock, and you can easily buy an option contract for $100 or less, even if the underlying stock is worth hundreds of dollars itself. This means that options allow you to trade in these big name stocks without actually requiring you to have a huge trading account. Besides stocks, you can also trade options on exchange-traded funds, market indexes, futures, commodities, and more. In addition to requiring much less buying power than stocks, options also allow you to be much more versatile with your trading. In a certain sense, trading stocks is boring. You never have more than two possibilities. You can either buy or sell the given stock. Besides buying to open a stock position, you can also short sell the stock if you have a margin account with enough funds. But if you have a cash account, you can literally only go long. This restricts your trading tremendously. With options, the options are literally endless. You can build a perfect position for every market scenario imaginable. Let me show you a specific example to prove this point. For this, let's take a look at Microsoft's recent price chart. As you can see, at the time of making this, Microsoft was trading at around $184. If you're only trading stocks, you could buy Microsoft at the current trading price and make money if Microsoft's price rises. For every $1 increase in Microsoft's price, you earn $1 for every share of Microsoft that you own. But each of these shares will cost you $184 to own. So to own 50 shares of Microsoft, you would already have to put down close to $10,000. If you have a margin account with enough capital, you could also short sell Microsoft. Doing this would allow you to profit from a drop in Microsoft's price. So to recap, as a stock trader, Microsoft's price either has to rise or drop a lot for you to really make money. If it stays right where it is or only moves a little bit, a stock position wouldn't really be worth it. As an options trader, however, you could construct any position you wanted to. You could mark any price levels on this chart and you would be able to create an option position that has these exact price levels as its break-even points. In fact, you would probably even be able to create multiple different option positions with different payoff profiles with these exact break-even points. For instance, let's mark $163 and $208. Certainly a very wide price range. Here you can see an option strategy with such break-even points. As you can see, this strategy profits if Microsoft's price stays between $163 and $208. Note that options have a fixed expiration date. This means you will always have to assign a max time frame to your options trades. This time frame can be everything from a few days up to multiple years. So if you expect Microsoft's price to stay in between $163 and $208 over the next 2 months, this position would be perfect. You would never be able to express this market assumption with only stocks. Next up, let's look at a different example. You think over the next 70 days, Microsoft's price will make a big move, but you aren't sure in which direction. The reason for the move could be upcoming events, technical indicators, or anything else. By only using stocks, you would have to decide which direction you want to bet on. But with options at your disposal, you could construct a position such as this one. As you can see, the further Microsoft's price moves, the greater this position's profit. The direction of Microsoft's price move is completely irrelevant as long as the price moves in one direction. This position only loses if your market assumption was dead wrong and Microsoft's price doesn't budge at all. Let's look at one last example before we move on. This time, you think Microsoft will stay below $200 over the next few weeks. But you aren't sure whether Microsoft's price might drop or not. Then this option strategy might be a good choice. As you can see, this strategy is profitable as long as Microsoft's price stays below $205 until the expiration date. But the best possible case would be if Microsoft's price rises slightly to $190 until the expiration date. But even if Microsoft's price drops hugely, you would still achieve a profit. Hopefully, these examples gave you a good first impression of the versatility that options offer. Instead of being limited to buying and selling the underlying stock, options allow you to profit from almost any market scenario imaginable. This gives you a much more dynamic and precise approach to trading. That's also the reason why professional trading firms such as hedge funds or investment banks use options and other derivatives to engineer the perfect position for exactly their market view. Besides using options to gain directional exposure to a security, you can also trade options to gain exposure to factors that stocks simply aren't affected by. You could, for example, construct a position that generates a profit every day as long as a certain security's price stays below a specified price level. In other words, you can put a deadline on a stock's ability to surpass a chosen price level. If the stock fails to move beyond this price level within the specified time frame, you get paid. Besides time, you can also bet on changes in volatility. If you believe that XYZ's volatility will decrease or increase over the next 40 days, there's an option strategy that profits from exactly that. Instead of only trading on one security, you can also combine option strategies over multiple assets, different time frames, markets, price ranges, risk levels, and much more. It's also possible to combine stock and options positions for purposes such as hedging or increasing profit potential. With that being said, options do come with an added learning curve compared to stocks. Stocks are rather basic trading vehicles, which is why they are so easy to understand. So if you aren't willing to put in the time to really understand options, you should stick to stocks. But in my opinion, the time it takes to learn options trading is 100% worth it. If you want to start your options trading journey, I highly recommend checking out my free options trading courses on tradeoptionswithme.com. Now, let's quickly sum up some of the key points of this video. First of all, when should you trade stocks? If you are a long-term passive buy and hold investor that likes to keep things simple, stocks are a better choice than options. Furthermore, if you don't want to put a definite time limit to your trades, stocks are the way to go since options always have a fixed expiration date. Otherwise, if you're mainly active in illiquid markets such as low-cap stocks, options aren't the best choice due to their relative bad liquidity in these markets. If, on the other hand, you prefer a more active, higher risk and higher reward trading style, options are a great alternative to just stocks. The real power of options is that they allow you to build 100% custom trades that perfectly fit your portfolio, your risk profile, and your market assumption. Achieving this level of versatility simply isn't possible with stocks. But before you can take advantage of the benefits that options offer, it is fundamental to first truly understand how options work. This doesn't mean that you need to buy some overpriced options trading course, but you should definitely educate yourself extensively before actually trading options. You could, for instance, check out my 100% free options trading courses to start your options trading journey. With that being said, I hope this video gave you a good overview of stocks versus options. If you enjoyed the video and learned something new, make sure to smash the like button, subscribe, and turn on the notification bell. Thanks for watching.